So there are two types of costs in an enterprise: direct costs and indirect costs. When we talk about costs, these costs are assigned to a cost object. Cost object is where cost measurement is decided. It could be a product, it could be a service, it could be customer, department, or center. There are different cost classifications. And there are costs that are directly related to the cost object, and there are costs that are indirectly related to the cost object. Those that are directly related to the cost object can be directly assigned to the cost object. Those are indirectly related. They are assigned based on certain agreed rules. So there are direct costs and indirect costs. But these direct and indirect costs could be either fixed costs or variable costs. The costs could vary with the volume of production, or costs would not vary with the volume of production. They're fixed. If you take an example of a production department, production manager's salaries is a direct cost, but it's a fixed cost. Materials, the metered electricity on production is a variable cost, and it's a direct cost. The delivery cost of production of goods is an indirect cost, but it varies with production. Salaries in the finance department that serve the production department, it's a fixed cost, but it's an indirect cost. So one classification is to look at costs as direct and indirect. Another classification of costs is to look at them as variable and fixed. But the challenge here is how accurately we can assign indirect costs to cost objects. We know that the fixed costs and the variable costs, they both can be direct costs or indirect costs. So the factors that we must consider in assigning indirect cost to cost object is how material is the cost item, the available information, and whether we can gather this information, whether sufficient technology or capabilities are there to gather such information. And third is the design of operation. Is this cost assignment, cost allocation is exclusive to cost objects? The general rule is broader the definition of cost object, higher the proportion of total cost that the cost object can accept. And it brings more confidence to the manager about the accuracy of the cost allocation. So we talk about indirect costs and fixed costs. Indirect costs are operational costs. Fixed costs are strategic costs. That means it's long-term costs. Indirect costs are short-term costs. So when we look at the planning, control, and decision-making aspects, in planning, indirect costs take center stage in budgeting, and fixed costs take center stage in strategic plans. When it comes to controls, indirect costs take operational focus and fixed costs take strategic focus. And the decisions about indirect costs are made by the operational teams, like the management, junior and middle management, and about fixed costs is the senior management who makes such decisions. There are direct and indirect costs that vary with the variation in the cost output. For example, building a house. So there are resources as inputs, which are building materials, and the cost object as output is the house cost. Now, some of these building materials may be indirect costs, and we have to assign these indirect costs into the cost object, the house, to allocate using a rule. We must then find how this building material cost is driven to build the house. How is the housing cost determined using building materials? We have to look at what causes its change in input with the change in output. So that's the cost driver, and that cost driver could be the material cost of the building material. Fixed costs do not have cost drivers because they're fixed. They're not. Only the indirect costs and direct costs have cost drivers. So there's a causal relationship between input costs and the output costs, and they can be caused by more than one cost driver. It's important to identify the key cost driver in this causal relationship when there are several cost drivers. The costing system that identify the cost drivers by activities conducted is called the activity-based costing system. Let's take an example. This problem focuses on the cost of operations. Here, the enterprise uses trucks to transport bottles from the warehouse to different retail outlets. There's variable direct costs and there's fixed direct costs. And we are required to calculate the total cost for two scenarios and the cost per kilometers for fuel and insurance if the truck is driven. And if you look at the 20,000 kilometers, the total cost is the variable cost, that's the fuel cost plus the insurance cost, and that equals 9,000. Cost per kilometer is 9,000 divided by 20,000 is 45 cents. Cost per insurance cost, if you want to calculate, it's 9,000 divided by 6,000. In the second scenario, when the truck is driven for 30,000 kilometers, there's fixed cost, doesn't change, 6,000, and our variable cost here is 30,000 kilometers at 15 cents, and the total cost becomes 10,500. Cost per kilometer equals 35 cents. And if you want to calculate per insurance, the total cost is 10,500 divided by 6,000. What we can see, cost per kilometer is decreasing with a greater mileage coverage done by the truck.